Yeah.
And with that, okay, here we go. So I would like to introduce to everybody Christopher Reece. All right, you are a CFA, you're founder and chairman and CEO of MJ Real Estate Investment Trust. Welcome to the show. Welcome to the show,
Thank you.
Chris. All right,
Thank you, Bill.
you got it. Thanks for taking the time today. You're based in Philadelphia, right?
That's correct.
Very
Yep. Just
good.
outside of Philadelphia.
All righty. And you've spent time, 3 decades across institutional asset management, private real estate, alternative investments. Pretty impressive. So you've seen multiple market cycles, different asset classes, and now you're operating at the intersection of, say, institutional real estate and an emerging industry here. And this is going to be a very fascinating conversation moving ahead. So, with that, uh, with the 30 years in asset management, starting at Vanguard, and hopefully I got that right, moving through
Yep.
Turner, FS Investments, and now MJ REIT. How do you describe that professional arc, that whole
Yeah.
arc that you've taken?
It's a good question, Bill, and it's interesting because with my almost 30 years in institutional asset management, I spent the first half of those on the public side and then transitioned to private assets about 14 years ago. And the reason I did that is while I was at Vanguard, we had built some institutional portfolios that we thought were properly diversified. And then the tech crash of 2000 occurred, and all of a sudden those correlations go to one. The diversification that we thought we had went out the window. And I
Mm,
realized there had to be a better way to provide investors a more diversified approach to building portfolios. And that would include assets that weren't marked to market on a daily basis, more private assets that have the ability to exhibit lower correlations and also enhance investor returns. And so when I transitioned to the private markets, I started with FS Investments, now called Future Standard. And we launched the industry's first private business development company, or BDC.
mm,
If you're not familiar with BDCs, BDCs simply provide capital to either a private or small public US company. And when I left my last firm, I looked at why those BDCs were so successful, and it really came down to high demand and lack of capital. And
mm,
when I launched MJ REIT, I looked at several different industries. I looked at oil and gas, I looked at infrastructure, I looked at currencies, precious metals, and I kept coming back to the cannabis space as one that not only happens to be one of America's fastest growing parts of the US economy, but it's doing so with limited involvement on the banking side. And add to
right.
that, it has a very small institutional footprint, at least at this stage. But that institutional footprint will certainly come at some point in the future. And when that flood of capital happens, we're going to see asset prices balloon across the industry. And so for us, and the fund and our investors, we really are taking advantage of scarcity of capital within
Mhm.
one of the fastest growing industries in America.
Wow. There we go. So
Yeah,
that's kind of your catalyst for founding MJ REIT and focusing on real estate within the cannabis industry then. Can you
that's
expand on
correct.
that some?
Yeah, absolutely. And we look at it, and this is what sets us apart from other financiers in the marketplace is when we look at a potential deal, we assume cannabis goes away in every transaction. And we're just simply financing a piece of either industrial or retail commercial property. So because we assume cannabis goes away, we don't provide the borrower with a bump in valuation associated with any improvements. Because Bill, oftentimes what will happen is, let's say you and I get together, we apply to the state of California for a license to cultivate, and we get approved, and then we need an industrial property for that, and let's say we find an industrial building and we buy it for $2 million. Well, it's
Mhm.
not out of the question that we need to put 6 million of improvements into that property. Think about irrigation, lighting, HVAC, high tech security. And now, in our mind, that building is worth $8 million. And it is to a cannabis cultivator, but to a standard industrial tenant, they don't need
Mm.
14 air conditioners and state of the art security. And so we would look at that from the fund standpoint and say, we're going to value this property at two or two and a quarter 2.25 million. And then we simply underwrite a senior mortgage at up to 75% LTV on that lower valuation. And that's really
Nice.
kept us out of a lot of the frothier deals in the marketplace. And we have yet to have any deals that have gone sideways. So we have zero defaults inside of the portfolio. And we go back to September of 2022. So we've
Nice.
had a really good run. And for our investors, it's really the monthly income that we're able to generate consistently. And
Mhm.
that's really why our investors continue to flock towards the strategy.
Nice, nice. So, why did you feel that the REIT structure was the right vehicle for this, Chris?
Yeah, I when I designed the fund overall, I wanted to have a strategy or structure that offered a significant amount of what I'll say, investor ease. And so we created the REIT structure or chose the REIT structure because not only do we offer monthly purchases, monthly redemptions, we have monthly distributions and monthly valuations, but inside of the REIT structure, it serves as a pass-through entity. And so our investors only are paying taxes on 80% of the distributions that we provide on the federal level. And so because we're such a high income strategy, it just made sense to go with the REIT structure and help our investors generate additional returns simply because you're not paying tax on 100% of it.
Nice, nice. Think of the investors there first. So, yeah.
Yeah.
So, what gap did you see between, say, institutional real estate and your sector? This is the cannabis sector, the land
Mhm.
sector of it. What gaps did you see? Uh,
Yeah,
between, yeah.
the biggest gaps that I noticed when I initially looked into the sector overall was just the lack of capital or scarcity of capital in the commercial real estate market, specific in cannabis. And that
Yeah.
really gets to the point that you can't go to Wells Fargo and get a mortgage or JP Morgan or pretty much any other financial institution out there. And because of that, you need that capital
Hmm, hmm.
and are willing to go and pay a little bit more for that. And when we underwrite, and this is also important from a diversification standpoint, which today we have in the portfolio 32 properties spread across 11 states. But for us, when we look at the opportunity, it's really we're underwriting a short-term senior mortgage, think 2 to 4 years in nature. So these aren't long-dated
Mm,
mortgages, because
mm.
quite frankly, I don't know where the market's going to be in 5 years or 10 years or 30 years. And will we get some sort of legalization at the federal level? I think at some point we will. But that point is still 2, 4, probably even 7 to 10 years away.
Right. Okay. Okay. So this is a great transition question to, yeah, where are we going to be in the next, say, 2 to 3 years? And for you, Chris, with your fund, specifically do you want to see your fund at within the next 2 to 3, say, to 5 years moving
Yeah,
ahead?
and so it's a good question. And so the fund, while we're taking advantage of a scarcity of capital in the market today,
Hmm.
even if banks were to get into the space, the fund is designed to run into perpetuity. Right now, we're putting money to work in the market between 12 and 15% on those short-term mortgages, which
Hmm.
allow us to target a 10+% annualized distribution. And of course, I should note in talking about any types of return that past performance is not a guarantee of future results. But
Yes.
it's allowed us to put that money to work and generate a better return stream for our investors. So even if banks came into the market, yes, instead of lending at 12 or 13%, we would have to lend at, let's say, a more normalized rate, call it 8,
Hmm.
9, 10. But on the flip side, I have zero leverage in the portfolio, and we could go out and put 0.5 to 1 leverage into the
Hmm.
portfolio and still be able to meet our 10% target. And by the way, I
Right.
should also note that there are other REITs in the market that are upwards of 3 to 1 on their leverage rates.
I see. I see. Okay. So cannabis real estate, it's sits at the intersection of regulation. It's a real asset, and it's an operational risk like any other operation. How do you think about underwriting in that kind of environment?
Yeah, and so we, as I mentioned, look at it really as a non-cannabis piece of real estate. And so everything
Yes.
that you would do to analyze a standard industrial property, we do that as well. But in addition, because of the cannabis overlay, we do, of course, analyze and underwrite the tenant on the property itself. And have they been through a market cycle before? What's their net worth? Many of the mortgages have both corporate and personal guarantees associated with them, given the status of the industry. And it's really, have they been able to successfully generate enough revenue for in the past to generate to pay their interest expense. And so for us, it's not only analyzing the actual real estate, but it's also understanding the tenant that will occupy that space.
That's nice, nice. Um, so let's see. So how do you separate the regulatory noise that you may be hearing from different states, different localities,
Mm-hmm.
different counties, perhaps, or
Yep.
localities, from those real estate fundamentals? And it seems to me you've got a great process here where you're underwriting for safety. And but how do you separate out that regulatory noise? I call it noise coming
Yeah.
from different government entities here.
Well,
From
and this
those,
is
yeah,
Yeah, and this is the most amazing aspect of what we do. Is so if you think about cannabis overall, it's still federally illegal. So right now, it's a
yeah,
what's which is considered a Schedule One controlled substance, where the DEA deems it to have no medical benefit and a high sense of addiction. We know that is not true, and President Trump fast tracked the ability to get cannabis rescheduled from a Schedule One to a Schedule Three. That will be a positive for the industry. But for us, it's legal on at least a state basis in
yeah.
about 41 states, DC, and 3 U.S. territories. Interestingly, you still can't cross state lines. And so when a new state comes on board, they need to grow, process, and sell that cannabis within that particular state. So right now, there is a tremendous amount of barriers to entry because you can't have, at least today, have Philip Morris come in and buy 100,000 acres in Arizona and grow cannabis and then transport it all over the country at a low cost. So you can't get that economy of
Can't do
scale.
it. Mm, mm.
In addition to that, every state, and you'll see more and more come online, if you're the governor of a state and you raise taxes, most likely you lose your job. But if you legalize cannabis on, let's say, the medical or adult use side, you're able to generate additional state tax revenue that can be used for schools, roads, social programs, et cetera. So as a governor, you have a financial incentive if your state isn't already legal to actually move forward in legalizing.
Okay. Okay. So, different sort of question here. What risks do investors misunderstand the most in your industry?
Yeah, I think the biggest risk
That,
in what we do is in how we mitigate that specifically in the portfolio is that we look at going back to the underwriting is we look at every deal and originate every deal assuming that cannabis goes away. The
yeah.
the missteps that many other people in the market have taken is that they look at it and say, okay, cannabis is going to always be here, and we're going to provide that valuation at a cannabis valuation as opposed to a non-cannabis valuation. And when the tenant stops paying and you need to re-tenant that property, now you're forced to look for a cannabis tenant. And of course, it's the easiest to get to swap out and get another cannabis tenant. But let's say you can't find one. Or
Mm,
let's say that, for example, you're in an unlimited license state, meaning that the state will issue as many licenses as supply and demand dictate. Now, all of a sudden, you have two or three other properties, competitors, and that creates additional supply. And now, all of a sudden, you're not generating as much revenue. So we want to make sure that we're not beholden to always have to find a replacement tenant because listen, at the end of the day, we are debt managers. We focus on downside risk first, and then
mhm.
how we can make our returns for our investment second.
Ah, all right. Well, Chris, now MJ REIT now holds 30 plus properties across 10 states. So, how do you think about portfolio construction and geographic diversification. How does that
Yeah, and
work?
it's and geographic diversification is key for us, as diversification is in any investor's portfolio. Looking at the fund overall, we'll continue to expand as we see opportunities because, again, for us, it's looking at the underlying real estate and does it make sense from a non-cannabis investment? And if it does, then we're happy to go in any one of those 40 plus states and underwrite that property. It's
Right.
also beneficial to have that geographic diversification because if if your state imposes, let's say, a new tax that comes along, well, as an operator, you're making less money now because there's an additional hit to your bottom line. And so we want to make sure that the portfolio is geographically diversified as well as in the number of holdings that we have.
Nice. Okay. So, all right. What traits you'd mentioned about high quality tenants already in this?
Mhm.
What traits would you define a high quality tenant to have
Yeah.
in this space?
I want to see the tenant have some history of operating within the cannabis space. I want to
Okay.
see that they've gone through a market cycle before. Because if you
Yeah.
go back, 4 years, there was chatter that potentially cannabis would be either rescheduled or made legal. You saw
Hmm.
all of the publicly traded Canadian cannabis stocks go up significantly in value. And then over that last 4 years, you've seen those stocks decline by 90%, 80% in some cases.
Right.
So, it's one for us that we need to really understand the operator, their success in the past. What does management look like? How is it the ownership structured? What skin do they have in the game? We like to see and incorporate, as I mentioned, personal and corporate guarantees into the loans. And it's
Yeah.
interesting from a psychological standpoint when there's a personal guarantee involved, whether
Hmm.
that's 10,000 or
Hmm.
$1 million, being able to
Yeah.
come after you makes you really understand the severity of making sure you meet your interest obligations. And so we'll take all that into consideration when we originate these deals.
Okay. All right. And so, industrial retail assets, they behave differently
Mhm.
within the cannabis ecosystem, correct? Or
Yeah, and kind
how'd
of
you?
obvious,
Yeah.
but if you think about the assets overall, so industrial versus retail. Well, number one,
Mhm.
industrial is much larger, so the square footage is much greater. There, we're looking at replacing that cannabis tenant with a non-cannabis tenant on the industrial side. But think about the dispensaries. Your dispensaries are very akin to a coffee shop, for example, or a Verizon store. And so when we look at location on the retail and dispensary side, we want to make sure it's in a location that could support a non-cannabis tenant. Again, think about Verizon or Starbucks. What's the
Hmm.
traffic? What's the look like? What's the proximity to major arteries, major thoroughways? What's the population around the area? So all of these demographic aspects come into play, and they do operate differently. If you look at the portfolio today, we're about 60%, 63% in industrial, and we have the remaining in the retail side. So you do get a mix of both retail and industrial in the portfolio, as well as that geographic diversification we spoke about earlier.
Right, right. Chris, you've raised billions across your career here. You've worked closely with RIAs, family offices,
Mhm.
and institutions as well, of course. What does effective capital partnership look like today for you?
Yeah, it's a great question because for us, because of that illegal status at the federal level, and I have the word cannabis in my PPM, and that
Hmm.
typically takes us out of many of the independent broker dealers, the wirehouses, and many financial advisors, simply because their firms aren't going to traffic in a Schedule One controlled substance. And so even though we don't touch the plant and we're not lending directly to an operator, but rather financing a piece of commercial real estate, we still can't go and we're not on platforms out there. So our capital is raised mainly through high net worth investors. This is we are registered as a 506C, meaning that we need to have every investor has to be accredited. And with that accreditation, we also have a low minimum, so that helps as well. Our minimum is only 25,000 in the fund, so we help investors diversify. But it's really through partners like this, Bill, where we do a podcast and somebody listens
Yeah.
and they're like, you know what, that's interesting. Like I should take a deeper dive, and then we set up a call and see if the an investment is right for his or her own personal portfolio. But from the institutional side, we really haven't seen a lot of institutions or hedge funds or otherwise taking positions, but that will come. That will
Yeah.
come for sure.
So these high net worth investor expectations, have they changed over the last 5 years? That's has
From
that how has the change everything changes, I guess, but
yeah,
has that changed?
well, and I think from an investor standpoint, it's really you worked hard for your money. Number one, you don't want to lose it, and number two, you want to earn a decent return. And so those expectations, I suspect, will stay in place forever. Now,
Yeah.
within your investment portfolio, you generally will have an allocation to debt. You'll generally have an allocation to bonds. So think of growth and fixed income. Um, and we generally fit because we're mainly a debt portfolio in that fixed income bucket. And with rates are where they are, we're able to generate for our investors a much higher consistent monthly income than they were
Mm,
able to find or get elsewhere in the market. And so again, it's just about diversification, and
mm.
even on the real estate side. Let's say, Bill,
Yeah.
I know you're value add multifamily. Let's say
Yeah.
within that real estate bucket, we break that up and say we're going to have some value add multifamily, but we're also going to have thematic real estate, and that thematic
Oh,
real estate, whether it's a mobile home park or storage, self-storage unit. Well, cannabis helps and fits in that diversification bucket. So we help diversify your real estate, or we can be used on the fixed income side to augment or increase your monthly
mm.
cash flow.
Nice, nice. Um, how does what does transparency, excuse me, really mean in alternative investments? Would you
Yeah.
call yourself an alternative investment specifically? And how does transparency look to you in
Yeah,
there?
so we are considered an alternative investment because we're not investing in the public stocks or bonds in the market. And transparency for me is critical, and that's why I designed the fund the way I did. I could have designed this fund as a traditional closed-end fund, and you put in $100,000. I call that capital when I have a deal. It's locked up for 8 years, and then I begin to return that capital. Well, for me, while there are strategies out there that have done a good job for investors, I wanted more transparency than that particular structure offered. And so that's why I went with monthly liquidity. So we don't have an 8 year lockup. I will note that we do have, I'll call it a 1 year lockup, but it's really if you exit within the first 12 months, there's a 5% penalty for early withdrawal. After
Hmm.
12 months, you exit at the net asset value. So you have the ability
Huh.
to redeem and create your own maturity schedule. You have the ability to add to your portfolio from a flexibility standpoint. And then we price the portfolio on a monthly basis. And so every month we're updating the net asset value of the portfolio. We launched at $25 and $25 even, and today we're at $25.05. And so we've had a nice little slow increase over time, but the real
Yeah.
return is driven from the large monthly distributions that we make to our investors.
Okay, cool, cool. So, Chris, you got into this topic a little bit before, but
Mhm.
um, how do you see the institutional capital? You're a professional in this field, and people really want to know. Do you see institutional capital engaging with cannabis adjacent real estate
Mhm.
in the next 2 years, three, four, five? What is your professional opinion on this?
Yeah, I think over the next 3 to 5 years, you'll see a larger inflow of institutional investors into the marketplace. But I would caveat that by saying we would need to see some sort of change on the federal level, whether cannabis moves to a Schedule 1 to a Schedule 3, which would be great, and there is chatter, and even the
Yeah,
president is behind that, or we go federally legal, which is less likely because it's a lot harder to do that, especially in today's day and age.
Hmm.
It will happen at some point. That might be 10 or 12 years out, but I think from an institutional standpoint, should we see some movement on the rescheduling, I do believe that you'll see an increase in activity on the institutional side because it's an area
Yeah,
they're going to want to listen, institutions believe in real estate, number one, and institutions believe in diversification. And so the cannabis real estate area fits nicely in that bucket.
Okay. How do interest rates, regulation, and consolidation factor into that moving
Yeah,
ahead
and
in the future?
from, yeah, and from a rate expectation standpoint, of course, as rates rise, that makes the borrowing costs go up. So operators feel that pain, or owners that are paying mortgages on the variable side, unless it's fixed, will feel that pain. As we look forward with rates, many of our loans are, as I mentioned, short term in nature, so 2 to 4 years. So the portfolio has been around for 40 plus months now. So those original loans, as a matter of fact, one that we underwrote, one of the first loans that we underwrote, matured earlier this month on February 3rd. And so we keep them short term in nature because we don't know where rates are going to go, and we don't know where the industry is going to go. So as a risk mitigation tool, we keep those rates on the short side, or the maturities on the shorter side.
Excuse me. My
Mm-hmm.
bit of a cold there. Excuse me.
Oh no.
So yeah, what would sophisticated investors sometimes get wrong with investing in your space?
Yeah, I think for us, it's understanding the operator that ultimately will occupy that building
Oh,
and be paying the interest on that mortgage. And if you don't have, this is not an industry, given the complexity and that every state has its own unique rules and regulations, you need to be in this industry 100% of the time. You can't dabble in it. And
yeah.
so that's some of the mistakes that our competitors have made, is just not really doing this full time and being more part time in an industry that demands and has a significant amount of complexities over some of the other industries in the market.
Wow. Chris, you are a tried and true professional here. This has been a very thoughtful, very grounded conversation. You bring a very rare blend of institutional discipline and just openness to this asset class, and super professional here. This has been very amazing. Um, so thank you so much, Chris. Thank you for
Yeah,
your
and
time here today. Mm,
yeah, 100%, Bill. Thank you for the time. And
mm.
if you do want to learn more information, I'm sure you'll have our information listed, but you also can go to our website, which is MJ-REIT.com.
All right. And so for listeners, Chris is going to repeat where to find him online. Chris,
Yeah,
one
so
more time here.
yeah, thank you, Bill, for that. And so you can find us at www.mj-REIT, that's REIT.com. And on there, feel free to click, we have a schedule a call button if you want to learn a little bit more information. It's, of course, we fit a lot of investors' portfolio, but maybe we're not for everybody, but it's worth at least 10 or 15 minutes of your time to learn a little more.
Thank you, Chris. Thank you for
You're
your
welcome.
presentation here.